So, Jonathan, can you hear me too?
I can hear you.
All right, very good. So I'm pleased to have Jonathan VanHorn with us. Jonathan and I can't remember how we came in contact with each other, but we kind of started a conversation a few months ago. And one of the things that came up was some of our clients had difficulty kind of valuing or figuring out their ROI for their marketing expenses. And I talked to Jonathan about how to really calculate the lifetime value of a dental patient and how I believe there are a lot of different variables that were going into it. And I didn't feel like a lot of the consultants that were advising people how to value new patients were really taking into consideration all of the variables. And Jonathan just ran with it and came back with this incredible blog post and this equation, which I gave him a little bit of feedback for, but he really did almost all the work. And this is kind of what he's developed into this webinar. So I'm really pleased to share it with you. You can go to the next slide. And I hope you guys find this very valuable and helpful for kind of gauging your own marketing investments and how well they're working. So Jonathan's also the founder of Dentist Metrics. And I'll let him tell you a little bit about this. If you guys aren't familiar with me, I own great dental websites. We have about 300 clients in 3 countries. We help them with their online marketing, their website presence, social media, paid search, SEO, all that's everything related to online marketing. Jonathan, could you tell us just a little bit about Dentist Metrics and yourself, and then show us what you have to show us what we're all here to see.
Yep, absolutely. Thanks for that, Jeff. Thanks for having me on to talk about an issue I think that a lot of people overcomplicate. It is a complicated theoretical type number, but you can really simplify it and use it as a powerful tool. A little bit about me. I am a CPA, which is a certified public accountant. I've lived in the world of accounting and taxes and everything for 7 or 8 years, and then I moved into dentistry to where I act as a business coach. I help with accounting and bookkeeping and taxes, tax planning, all the traditional things the CPA does as well, but I also have the coaching. And I use dentistmetrics.com as kind of my platform to give actionable guides to dental practices, business owners, because I've really found that there's a lot of great clinical dentists out there that just need a little bit of help with the business side of things. And so on the website, I try to put really actionable, step-by-step, easy-to-read guides to help create action in dental practices, because as we all know, as business owners, action creates traction, which means you can make more money.
That's a catchy slogan. So let's get started with the presentation, and I think hopefully everybody's really excited, or as excited as I am to kind of learn about your equation and how they can work this in and plug in their own practice's numbers.
Yeah, absolutely. Let's get going. So what we're going to cover today, this is just our agenda. We're going to go over what actually the lifetime value of a dental patient is, how you can use this tool, this number as a tool in your practice, how often you need to be calculating this number, what actually goes into the calculation, so the separate parts of the calculation. At the end, we're going to have a question and answer session so that everybody, if you have any questions that come up during the session that you need me to explain farther, extrapolate on, we're more than happy to do that. It's going to be really informal. And so if you have any questions, you can put them into the chat box, or you can actually get a notepad out, write them down, and we'll answer them at the end. There is another thing I want to cover really quick. We are going to give out a tool at the end of this webinar. So if you are one of these people that doesn't like to do these types of calculations, you're scared you're going to mess up the math, anything like that, I'm going to have a really easy tool for you to use at the end of the webinar that you can actually just download and plug a few numbers in, and it will give you this number for you, easy peasy, no mess. So before we get started into the agenda, I want to give you one piece of information that if you take nothing else away from this webinar, take this little nugget with you. This is something that a lot of people mess up, and that is that the lifetime value of a dental patient is a number, and numbers are worthless without context. So what do I mean by context? Context is if you think of if you remember the old adage of anything is the sum of its parts, this number, the lifetime value of a dental patient, is the sum of multiple different little calculations. You have to take the context of the calculation in order to be able to use this tool effectively. So, for example, let's say I had a dentist come to me and said, I collected $1 million in revenue last year. And then he said, I'm going to collect $1.5 million in revenue this year. That sounds great. It sounds like you're doing 150% better than last year. But if you spent $750,000 more to get that $500,000 in revenue, those two numbers have no context. They have no meaning. So you have to look farther down into the context. So another thing to remember about this number is that it is an estimate. There is no way to get down to the penny on this. So if you actually look up the financial equation of the lifetime value of a customer or anything like that, it's going to have all these really complicated financial theories attached to it, such as the time value of money, discounted cash flows. You have to be able to predict interest rates and things like that over time. It's really, really difficult to do. So I throw out all of the complicated levels in this and get it to where it's bare bones as much as possible, but still actually actionable. So they say that complexity is the enemy of execution. So we've tried to get rid of as much complexity to this calculation as possible. So a lot of people and a lot of consultants have this standard that they'll say sometimes for what the average value of a new patient is. I know whenever I've spoke with other consultants, I've spoke with attorneys, dental practice owners, office administrators, pretty much everyone has thrown around a number to me that they've said that, yes, this is how much a dental patient is worth. If you actually quiz them on that, they don't really know how to quantify that. Has anybody here ever heard of a standard? And if you have, you can put it into the chat box and do me a favor and put the year that you actually heard that, if you have actually heard that. Okay, well, no one may have heard it. If you did, just go ahead and write down on a piece of paper what number you heard and what year you heard it in. For the research I've done and for everyone that I've spoken with, basically for the past 15 years, the number that always gets thrown around is about $10,000 per new patient is the amount of money a patient is worth to a practice. I've seen that in legal documents. I have seen that in transition services. I've seen that in consulting references. And it was just $10,000 flat is the value of a new patient. So I'm telling you right here and now that you need to throw out any industry standard you've ever been told, because the fact of the matter is that this number is different, uniquely different for each practice that is out there. There's never going to be one practice that is going to have the same exact number as another one. For example, if you have a high volume practice that has a low average dollar per service per patient, such as a Medicaid type practice, or and you compare that to a high-end cosmetic dentistry practice, there's just not going to be the same value per patient, because in the higher volume practices, more patients tend to leave year over year in comparison to higher value practices. It's just the way the world works. And going back to how this has been kind of the standard number that you get seen thrown around for the past 15 years, the business environment has changed dramatically in the past 15 years. There's corporate dentistry that has popped up. Marketing is more profound and more complex and more efficient than ever before, so that is making it more competitive. We have a widening retirement gap for dentists. I read some ADA articles that had said that 20 years ago, the average retirement age for a dentist was somewhere in the early 60s, and now in 2015 now, that age is in the early 70s. So you've had this group of retirees that just isn't retiring because they are afraid of the economy, they're afraid of the business environment, and they just want to keep practicing. So At the same time, you have more dental students coming out of dental schools that are starting up their own practices because there's no one selling their old practices. So you've got even more competition, and again, you add in the corporate practices and everything that goes into that, and you have a very, very different business environment than you had even 10 years ago. This is not the day and age where you can just hang up a sign and expect to be successful. So getting into this, what is the lifetime value of a dental patient? To put it bluntly and simply, the lifetime value of a dental patient is the average amount of money each patient in your practice is worth to you or your practice. So I'm actually going to run us through a really simple example of this to make sure that everyone is on page for this before we go into some of the reasons why we actually look into this number. So let's just say, hypothetically, there is a dentist that has 1,000 patients. They're going to stop doing dentistry in 10 years. Each patient of this dentist generates $100 a year in revenue, and each of those patients costs $50 a year to service. It's pretty easy math from that, in that you're going to take 1,000 patients times the $50 in profit times the 10 years. That means that dentist is going to make $500,000. You're going to divide that by the total number of patients, and that would mean that the lifetime value of a patient is $500. This is a very simplified way of looking at it, and this number varies greatly from practice to practice. You can see this number be down to 500. You can see it be up to north of $10,000. So I've showed you a simplified version of this calculation, just so that if there's anyone who hasn't seen this, isn't really understanding why we're talking about the lifetime value of this. This is something that giant corporations track religiously because it is something that they can use as a gauge to see how well their business is doing, to see how well they're working on their brand, how well they're doing their marketing. It is just a really great tool. So the first area we're going to talk about is internal marketing. So there's a lot of people that talk about internal marketing, and it gets sort of confusing to some people because a lot of people believe that is just how well you get referrals in your practice. And that's not the case. Internal marketing is literally everything that goes into the patient experience. That's whenever they walk in the door for the first time, when they're greeted at the front desk, they're made to feel like royalty, and then they leave with a good feeling on them. It's not just referral programs and things like that. Internal marketing is everything that is going on in your practice. It absolutely has to do with how effective you have your recall set up, how effective you are at scheduling appointments in the future. But the way we're going to use the lifetime value of a dental patient in this webinar is that you can actually gauge how effective your internal marketing is by looking at the change in that dental patient lifetime value. So from our original example, it was $500. If that went from $500 in 1 year to $400 the next year, more than likely something in your internal marketing is going wrong. So if you see your value decreasing, you're doing something wrong. If you see it increase, you're doing a good job. And if it stays flat, you're probably teetering on doing something that you could do better. So the second way we're going to use this tool, this number, is that whenever you're looking at your external marketing, you can actually use it in a way to calculate how to profitably go and find new patients. So, for example, let's say that if your patient is worth $500, you can use up to $500 to acquire a new patient to break even. If you take that a step farther, you're going to realize that you can actually calculate profitable ROIs on many different avenues. So you have your print advertising, web marketing, your website, your pay-per-click advertising, your radio ads. All of those can be tracked down to receive your ROI if you have this lifetime value of a patient. The only thing you have to remember with that is that number is over the lifetime of that patient. So, for example, let's say you have your average lifetime of a patient is 5 years. That would mean that you would, over 5 years, make that money back. If your internal marketing were to break down in that time frame to where you're losing a lot more patients a year, then that number can actually dwindle. So it's important to remember that when you're looking at your external marketing, that you take it as this is a return over a certain amount of years look. So when should we calculate the lifetime value? I always say that this is a number you need to look at every year, because you can see dramatic changes whenever things start to ebb and flow within a practice. If you don't catch the change in the lifetime value, you could potentially be missing really specific areas of your practice that you could improve to be much more profitable. There's an old saying by Peter Drucker that says, what's measured is improved. In this circumstance, what's not measured will not improve. So this, again, is a number we're going to be tracking as an approximation to use for our management decisions. Another thing to remember is that when you're looking at internal marketing and external marketing, if you're doing poorly year over year with your internal marketing, it could be that your competitors are just doing a better job of their external marketing than you're doing with your internal marketing. And a lot of the times, the way you can combat that is to focus on internal marketing, but at the same time, you're going to have to put up a really good external marketing fight in order to get those patients. In today's day and age, everyone is scrambling for the same patients in your market. So you have to have a strong external marketing front to be able to make sure that that your brand is being heard, that you're getting people into your system, so that your internal marketing can take over and strong, and you do not let them go. So now we're going to kind of go into the actual numbers that go into this calculation. And remember, if you need a copy of these slides, Jeff, are they going to be able to have? Are we going to be able to send them copies of the slides?
Yeah, we could afterwards, and we're also going to send a recording of the entire presentation.
Okay, fantastic. So don't get too bogged down in all the variables and numbers and things like that. I know that my eyes are glazed over in some of these things, and we're right after the holiday season, so people are probably feeling a little bit of a holiday hangover to be looking at too many math equations. So what actually goes into the calculation, the different areas that we're going to look at, the different parts we're going to look at in this calculation are the total collections for the practice over the year, the number of active patients over the prior year, the number of active patients over the current year, average collections per new patient visit, number of new patients every year being measured, your direct cost over the year, and your total number of patient referrals over the year. Now, whenever you're looking at your total collections over the year, you can actually use production if you are a fee-for-service practice, don't have a lot of write-offs, or you stay pretty steady in your collections. I really wouldn't suggest a practice that has a lot of write-offs or adjustments from their insurance company to use production, because this is actually a dollar and cents type calculation, so that if you're using a production number, you're going to have an inflated lifetime value, and that could lead to some bad decisions down the road. In some of these slides, you may see the word period, talking about something over a prior period or current period. If we're talking about a period, we're talking about a year, because if you try and do this on a different scale, different time frame, you're very likely to mess up the calculation in some facet, because it's just like whenever you're in chemistry. You've got to make sure that your denominator stays exact throughout, or else the whole formula gets messed up. The last thing to remember about these variables is that when we talk about direct cost, that is not your overhead. So your direct costs are specifically only going to be your cost for servicing the patient. You don't calculate in your overhead, which is basically your fixed costs, like your rent, your office supplies, your cleaning crews, things like that. Your direct cost is defined by this calculation. Are going to be your salary expenses to your hygiene and your clinical staff, your assistants, or your associates. It's going to have your dental supplies and your lab fees included. And again, don't get bogged down in the numbers. We're going to have an easy-to-use spreadsheet or easy-to-use tool at the end of this to where you can just plug it in and it will calculate it all for you. I'm just explaining these so that whenever we go over the concepts we're about to go over, you can kind of see where we're going with it. So we actually have a hypothetical practice that could very well be a real practice out there. So $800,000 in collections every year. It's probably the average single owner single location dental practice. You may have been struggling for a while to kind of break into that $1 million a year practice. It has about 1,200 active patients, 1,250 number of new patients over the year. They, on average, their new patient visit is a $300 service. They have 150 new patients over the year, and then they have direct costs of $150,000 over the course of the year. And finally, their patient referrals are 75 out of that 1,250. So the 1,200 is for instance, it's now 2015. This would be like the end of 2013, and 1,250 would be the end of 2014 as a way to kind of break that down into a more real-world type example. So these are the different variables. These are the different numbers that go into it. The actual parts of the lifetime value calculation has a few different areas that you need to be familiar with, because if any one of these break down, your value is going to dip. So if you see a dip, you need to be able to look and see, okay, was it because of my churn rate? Was it because of my profit margin? Was it because of my referral rate? Was it because of my average collections to active patient? So to kind of go over these in a little bit more theoretical terms so that you can actually understand why it's important for us to keep up with these numbers, we're going to see that the churn rate is actually the percentage of patients that leave your practice. The profit margin is going to be how much money you get to keep from the revenue coming in from those patients. And the referral rate is how often your patients are going to refer new patients in. Your average collections by active patient are going to be the patients, or how much money you're making on average per patient, how much money they're actually spending with your practice. And one important key to put in there is that we have to remove the new patient revenue in order for this calculation to work. And that's the reason we had it tracked in the prior slide. So we're going to go into the churn rate using these numbers that we came up with a couple slides ago. And if you look over to the left, the way you can read this, if it's highlighted in blue, that means I'm actually going to use this in that calculation. So the churn rate uses the number of active patients over the prior year. So for our example, this would be like 2013. And then this number would be the number of active patients over the year, which would be 2014. And this number would be the number of new patients over the year being measured, which would be 2014, if we're using today's environment to make this calculation. What this is effectively, this is the math calculation behind it. Basically what we're doing is we're trying to figure out how often our patients will leave our practice. So in our example, this practice is seeing 8.3% of their patient base leaving in a year. Once you calculate the percentage of patients that are leaving in a year, you can actually figure out how long, on average, your patients stay on in your practice. So if you have an 8.3% patient base leaving in a year, that calculates out to about 12 years of your patient life cycle. So what that means is for every 100 patients that come into your practice, 8.3 of them are going to leave every year. And then of the remaining, they're going to stay on average for about 12 years. So that's the churn rate and how you turn that in to find the patient life cycle for your practice. You're going to want to have this number be as low as possible. Now, there are times whenever this is more of an indicator of other people doing marketing better than you're doing your internal marketing. And there's times of this you just doing your internal marketing poorly. So this is a number that's really important to know regardless of the lifetime value. You need to be tracking this every year. So the profit margin is just how profitable you are for every dollar that your patients spend on you. So in this example, the practice we're using has a profit margin of 81.25%, which is a fantastic profit margin. I know there's a lot of people out there that would love to have that margin. And so for every dollar that comes in from the practice, you're going to get to keep 81.25 cents of that. So that's what the profit margin is. Obviously, you want this to be as high as possible, but this number can be pretty all over the place depending on your practices, philosophies, and policies. So the referral rate is the number that we talked about earlier about whenever your patients refer someone else. This is how often a patient of yours refers someone else into your practice. And the reason we have to know this is that whenever we're calculating how much a patient is worth to us, we have to remember that if we're doing a good job, they're going to refer other people to our practice. So while we only went out and received one new patient, we're actually getting other patients from that patient because they will hopefully be a referral source. Now, I've seen a number thrown out. There's a lot of people that are familiar with a marketer named Fred Joyle. I was watching, I don't know if it was a webinar or if it was an education course I was taking, and he said that the average is 5, for every new patient you get, you'll get 5 new patients as referrals from that patient. That seemed like an astronomical number to me. That's not what I see in my practices that I help with, and so I don't think that's a good number to use. So if you had heard a standard for that number, don't use that standard. Use the numbers that you're seeing and the performance you're seeing in your practices, and this is how you calculate that. You're effectively just taking your total number of active patients and taking the average of the total patients between this year and last year, and then dividing that by the number, or dividing the number of referrals over the prior year divided by that average, and that will give you the referral rate for you. So the next little piece is the average collections by active patient. Now, this practice, for $800,000 in collections with only 1,250 active patients, that's pretty high. $656.52 in revenue per patient. That's $656.52 that every patient is paying your practice for some type of treatment or procedure. That's pretty high. That would be a pretty high-end practice. You can see this number all over the place, but naturally, if you're a cosmetic practice doing Invisalign, doing implants, doing any type of high-end procedure, sedation dentistry, you're going to see this number higher. If you're more of a bread and butter type practice, this number is going to be lower. A lot of the times, this number will basically equal to hygiene visits if there's no complications or if there's no treatments spotted in those situations. So, and remember, we had to back out the average collections per new patient visit in order to be able to come up with this, or else the math just won't work. So bringing this all together, we're looking now at the calculation. We looked at the life cycle, and we're taking all this really fuzzy math that is complex in numbers, complex in theory, but when we bring it all together, the numbers in itself are going to be giving us the revenue generated by the patient, and it's going to be giving us the revenue from referrals that they would bring in over a 12-year period, because we looked at, from our example that we did the numbers with, that was the number we came up with, 8.3% churn rate, and then that was a 12-year life cycle. So we have to be able to take that over the 12-year period and add that in. So if you only took the numbers without the referrals in there, this number would look a lot different. If you can raise your referral percentages, then the number on the right will go up drastically, and you can actually raise the value at the end. Now, I know that I said that there is no standard for the $10,000 number I set earlier in the webinar. So you're probably saying it's funny that he ended up with over $10,000 in his, And that's just to show you that there is, in fact, ways to get this as a very strong, high number. But remember, that's $11,624 for the value of every new patient, but that's over a 12-year period. So that's a return of about $900 a year. And if over time your internal marketing goes down, that number, you'll start to lose that return that you originally had. But this is a way that you kind of look at the lifetime value.
So Jonathan, I got a quick question for you, and tell me if this is too early, but is this the kind of thing where if you get this number after plugging your practice's information into your equation, which you're going to give away at the end, can you then take out a loan from a bank that's payable over a 12-year period or whatever, and then make intelligent marketing investments based on that, and of course assume a little bit of padding? Does that make sense?
Absolutely. I mean, this is something that you need to use as a way, as kind of a litmus test of, does this make sense? In every business transaction we have, you have to have some type of data in order to make informed decisions. And so this is absolutely one of those tools that you could use.
Okay, very good.
Does that answer the question?
Yes, it did. Thanks.
Great. Well, that brings us to the questions part. Again, you think now is a good time to kind of demo the tools, or do we want to go to questions first?
If nobody else has any questions, I have one or more for you. I'll just ask that in the meantime. And if you guys would like to ask a question, you can type it into the chat box here, and we'll see it. So the other question was, you talked a little bit about the time value of money, and I'm assuming you're talking about interest rates and inflation. Do you have any kind of general rule of thumb for how dentists should value that? Because that's very speculative, and it depends on the actions of the Fed and other things. But is there any kind of general rule of thumb that dentists could use, even if they just pad it, to make those numbers a little bit more clear?
It really depends on the number of years you're looking at. So, for example, if you were to take, I'll be honest, I haven't looked at the interest rates recently. If you were to take out $10,000 a year and take that every year for 10 years, that you'd have $100,000. And the theory behind this, if anyone's unfamiliar, is that, yes, if you took $10,000 a year for 10 years, you'd have $100,000. So the value of that $10,000 income stream could be what's called discounted back to a sum today, to just a flat amount of money today. And so that there would be a certain number where it would be more worth you taking, say, $90,000 today rather than taking that $10,000 over the 10-year period. In order to be able to have like a rule of thumb for that, the number today is always going to be less than the end number. So, for instance, in the number I just said, $10,000 a year over 10 years would equal $100,000. How much is that worth today? It really depends, and again, that's speculative, but it would probably be in the $70,000 to $80,000 range is what I'd have to, just estimate off the top of my head, which would be about a 20 to 30% discount.
Hopefully not everybody didn't glaze over on that. If nobody else has any questions, can you show us the tool you developed? I think it's the spreadsheet. And then tell everybody how they can contact you to get a hold of this thing.
Yeah, absolutely. So this spreadsheet is pretty simple to use. I made it as simple as I could. For this spreadsheet, if you see these bright green fields, that means that you can actually change the number in the field, and it will update the value at the bottom. If you'll notice, this is the same amount of money or the same value that we calculated in the examples. Over here I have your direct costs, which would be your hygiene wage, dental assistant. In this example, we didn't have any associates. $30,000 for dental supplies, $15,000 for lab fees, which may or may not be reasonable depending on your circumstance. But if we were to change, for instance, the number of new patients a year over the period being measured, which was 150, if we change that to 200, it would change the lifetime value down quite a bit. And the reason is, that might be a little counterintuitive, is that if you have 200 new patients, that but you only have 1,250 patients at the end of the period, that meant of your original 1,200, you actually lost 150. So that meant that your churn rate was higher, which meant that it's actually going to reduce your lifetime value. So you can see how sensitive these numbers are. And everything that's in the dark gray, you don't have to change. There's a calculation in there. It will calculate all those little mini areas that we talked about in the webinar so that you can actually look at these numbers broken out, and then you can look at it as a number as a whole. If you want to go back in and you're like me and you just love spreadsheets and numbers and want to back into how the formula is made, it's right up here in the spreadsheet. And if you want a copy of this spreadsheet, just send me an email, jonathan@dentistmetrics.com, and I can absolutely send it to you. It's absolutely free. I love doing this kind of stuff and helping people out with this type of thing.
And so even if you weren't paying attention at all during the webinar, all you have to do is go into SoftDent or whatever your practice management software is and run the export for the total collections over a year, a number of active patients over that year and then the previous one. And and all these numbers can be easily exported by your PMS system, right?
Exactly. The only caveat to that is there's in software in general, there's an old saying, garbage in, garbage out. You've got to make sure that your data is accurate, or else the numbers will be meaningless. So you make sure that your numbers are good before you put them in the spreadsheet, and you're going to be fine.
I would second that. That is a legitimate saying in software. Any other questions from anyone for Jonathan? The audience has been rather quiet today. Anything else you want to impart to the audience? And we'll include your email address in a way for people to contact you in the follow-up email that'll include a link to the recording.
Okay, fantastic. No, just if anybody needs any help with this, I am more than happy to help out. We love doing this type of stuff and helping out practices, and this is what we really do is we hone in on the different parts of a practice that are deficient so that we can actually make a informed decision of how to best tackle issues in dental practices.
Okay. If anybody else, last chance for any questions before I stop recording.